All right, all right. Hello, everybody. Hello, Simrad. My name is Rosalie. I work at Panoptic, and this is the Future of Derivatives podcast. Today's episode, I'm welcomed by Simran. So, thank you, everybody, for tuning in. Thank you, Simran, for being here.
Thank you
And
for having me.
yeah, I think there's been so many really exciting things happening recently. The market's kind of looking really down, so that's not been too exciting, but lots of new projects. ETH Denver is coming up. That's going to be really exciting. And we're still, building, figuring out our launch for our vaults. And I'm very excited for that as well for Panoptic. And you recently changed jobs as well. So I would love to hear a little bit of a origin story of Monaco and how you joined the team and what's been going on recently with you.
Sure. Let me start by saying thank you for having me. It's a pleasure to be here. Quite excited to explore how we can work together. As for my background, so Simran Singh, CEO of Monaco Research. Started off my career originally in TradFi as a commodities trader at Goldman Sachs, and was most recently heading up DeFi trading at GSR. As for how I kind of came across Monaco or Monaco came across me, one of my focus areas while I was at GSR was helping incubate projects and really diving deep into ecosystems. And originally, GSR was being explored as a market making partner. And the Say Labs team, which is incubating Monaco, suggested, hey, we need someone at the helm who understands the nature of the problem that we're trying to solve. And that problem is building I would say, world-class global trading network, right? In a world where you have fragmented liquidity, where users still have to worry about bridging, and they want access to tokenized assets, real-world assets, you name it, having one encompassing unified liquidity layer while still providing a tailored, customized trading experience is the name of the game. In a world where everything is saturated, I think that is a key differentiation that we can offer.
Yeah, definitely. I think in DeFi, a big problem is the liquidity fragmentation. And it's great to see you guys trying to tackle this. Were there any specific limits or frustrations that you had kind of in the traditional trading space that caused you to focus more on protocol level infrastructure and kind of change your perspectives there?
Yeah, I think a lot of folks were building for purely other builders or crypto native audiences. And I think the name of the game is not really to be the most performant crypto product, right? I think the name of the game is to be the most performant product. And when you have a saturation of, dare I say, perp dexes that have launched, the likes of Hyperliquid, Lighter, Aster, all these pretty interesting products, I would say, all of them have catered to different demographics, but the actual pie that's worth addressing is the CME, NASDAQ, New York Stock Exchange, right? That is the actual tradable market that matters on the order of magnitude of trillions of dollars. And so if that is the goal that you're trying to achieve, then there's a few key considerations that need to be made. One of them off to top of turban is latency, right? Even the most performant blockchains are still bound by block times on the order of, 200 milliseconds, if not smaller. But traditional equity markets trade on the order of double-digit microseconds, if not milliseconds. And so like there is at least 1000x difference in terms of speed and latency and throughput. That is, I would say, necessary condition, but not sufficient condition. Going beyond that, I think you need composability, you need real world assets. You need to think about the fact that we still live in a world where regulatory clarity and adherence is super critical, right? I think permissionless markets have a place in the world, but if you're trying to go after regulated securities, the way you win is by building for those features and building for those users out of the box rather than trying to back solve into it.
So do you see kind of the future being more on chain or off chain? Do you think we'll figure out how to kind of create this really fast execution on chain eventually? I feel like nobody's come close to kind of what, Visa or other traditional companies have offered.
Yeah, I think the future of finance is very much on chain, but it doesn't have to be an all or nothing game, right? And I think that's how a lot of folks sometimes fall into this ideological mindset of like it's a all or nothing or us versus them. I don't tend to view the world as a C5 versus DeFi or TradFi versus DeFi. I think we sit in this unique intersection where those worlds are converging. You already see this in with the New York Stock Exchange adopting 24/7 markets and moving towards tokenization, right? So the on-chain rails are an inevitable part of the asymptotic future. The goal is how do we shape that while still thinking about regulatory compliance? right? I don't think it's really an on-chain versus off-chain question. I think it's more like, how do you build for these two audiences that have been previously siloed in their own ideological bubbles, and now that you're experiencing this convergence of both worlds?
Mhm. Yeah, no, I definitely agree. I was looking at your tweets, and I know you're very familiar with options, and
Mhm.
you recently wrote about kind of this lack of two-way flow in crypto option markets. And I'm curious to think kind of how you see this improving over time, where you think traders can find the edge that they're looking for, and with buying and selling options, and kind of seeing more demand for buying options versus selling options, and kind of
Mhm.
how we can create this consistency there.
Yeah, no, I think it's a very fair question. I would say one of the things that really makes crypto options quite interesting is that it actually reminds me of my commodities background, right? Oil producers need to hedge their production, oil consumers need to hedge their consumption, whether that's airlines or refiners. And so there's that organic two-way flow and dynamic hedging, which if you're a fundamental trader, you're following it from a fundamentals perspective. If you're a technical or vol trader, you're following it from a volatility surface perspective. And everyone is viewing it from their own dimension. Whereas I would say in crypto, most people will use options in BTC and Ethereum more as just directional exposures for leverage. And occasionally they'll approach it as a volatility trade, right? And the difference is when you're treating it just as an option and you just want directional exposure, you can get that by going long or short perpetual futures, right? And that's what most retail does. They don't want to deal with expiries. They don't want to have to deal with things like theta, gamma, no pun intended, but it's all Greek to me when you view it that way. But when you're trying to manage very specific exposure, specific risk, that's where you need actual vanilla options. And I think the way that emerges is primarily initially starting with dated forward curves, right? I think it's a bit putting the cart before the horse if we start saying, hey, why isn't there more liquidity in altcoin option number 673 when there isn't even a liquid linear forward curve for people to hedge, right? And so the question becomes, well, who is using these instruments to hedge? Well, it's namely your VCs who are just like, hey, I have locked tokens that I've invested. I want to de-risk myself. But if I can get that exposure while trading perpetual futures, then maybe I don't need options. And so I think there's this like inherent cold start problem where having options for the sake of having options is not really the answer. It's simply, am I solving an actual tangible problem where I'm trying to manage duration risk combined with convexity or optionality?
Yeah. I think it's very interesting, and definitely I've seen more people trade perps. But I do think that there's a big difference between options and perps, where you can potentially get the same exposure, but with a perp you can be liquidated much faster. And if you have an option for something, the price can change, and you could have eventually, if you made the right bet, profit. Well, for perps, you can get liquidated, and it doesn't really matter if you're right or wrong. If in that block on that moment, you end up losing. And so I wonder if it's more kind of this gamble mentality, and people just haven't really caught on to how to use options for risk management and volatility harvesting. And if this is just something maybe people need a little bit more time or more education on to kind of diversify their portfolios, or if it really just kind of there needs to be a different approach to how we kind of sell options.
Well, I guess one natural question that kind of results from that is what is like the average holding period for most people who are trading perps, right? So I think that will then directly inform the desire to have duration matched risk, where options have fixed expiries. Now, if you're talking about perpetual options, now we're moving to a more like esoteric and exotic realm where then you need to think about different risk parameters compared to your vanilla European style options, which are like, hey, where am I going to be 1 month from now? Am I going to be trading at BTC greater than or equal to 100K, or am I going to be trading less than that, right? If you have a very specific expiry in mind and you want to cater to that, options are a natural instrument to do that. But then you also expose yourself to things like theta, gamma, vol, right? If you just want pure directional exposure, I think perps still remain the best product. If you want to express a view and still want cheap leverage, but also want to have volatility exposure and convexity, options give you that. But if your holding period is relatively small, which often is the case when you think about who's predominantly trading these products, right? If it's retail dominated, this is not a 401k account where people are putting putting their retirement accounts into, dare I say, altcoin number 673 on CoinGecko, they might put it into Bitcoin. But if they're trading these long tail assets, they're typically holding them for shorter periods of time. And so trading options for shorter periods of time is not necessarily the most active market. But I would say the way that options enter into the mainstream is actually through prediction markets. So,
Mhm.
when we talk about duration, I feel like that's kind of the side of the market that gets underlooked, which is you don't need 1 month options, 3 month options when you can have 15-minute prediction markets on the likes of Call Chain, Polymarket. And that is, I think, how you kind of backdoor or Trojan horse options, or really just pure gamma into the crypto market for the long tail of assets. And especially if you look at the fact that zero DTE options on the S&P is one of like the largest flows in the broader equity market.
Yeah. No, I definitely agree. It's interesting to see how many different um, ways kind of options can sneak up on you. I think for how I got into it with Guillaume's research, a lot about how LPing is
Mhm.
selling options, and then we also have prediction markets, which are also a type of option, but people don't really notice this. So I think when figuring out how to abstract the complexity and making these things more accessible through structured products or vaults is definitely going to be kind of the next big thing. I think you also mentioned convexity, and I'm trying to see what your opinion is on if buying and selling convexity would become more balanced and more people are betting on volatility, more sellers are taking risk for earning premium. Do you think the variance risk premium is going to shrink or grow, and how do you see that affecting the market?
Yeah, I would say with any sufficiently high vol asset class, you will see this every now and then, and you used to see it in commodities, where you will have passive wing sellers. And that strategy tends to work until you have an event like October 10th of last year, where people then get their faces ripped off, right? And so in an asset class where BTC has evolved 50 to 60%, Ethereum can have evolved 70 to 80%, altcoins can have evolved 150%. I do think there's a natural desire to say, hey, why don't I sell this very unlikely insurance and compress this premium? And actually, if you look at crypto vol and how it's priced, at least for Bitcoin and Ethereum, which are far more liquid than any altcoin option, I would on average say that vol is more fairly priced in terms of risk premia compared to other asset classes.
Yeah. Definitely. I think that's something that we are also focused on figuring out kind of realized volatility versus implied volatility and seeing where we can kind of harvest that for different option strategies. On
Mhm.
Panoptic, you mentioned October, the mass liquidations for the basis trade, the carry trade. Do you see that these what is your opinion on how the systemic risk kind of applies to these trades? And has there been a shift recently, or do you think that they will still kind of succeed in the future?
Yeah, sure. It's funny you mentioned that. I had written another piece on why delta neutral funding trades are not free money, right? I think whenever people think the word delta neutral, they're like, well, if I'm neutral, then I have no risk. What could possibly go wrong? But inevitably, when you're putting on a funding trade, whether you're going long spot, short perp, or selling spot, going long perp to collect negative funding, there's inherent execution risk, right? The way you leg into and out of trades requires there to be sufficient liquidity in the order book or exchange that you're trading on. It requires sufficient capital, especially in a market where it's very volatile. You also need to then capitalize the perp leg. And if the altcoin that you're going long or short, for example, cannot be used to collateralize the asset, then you need to pony up both sides, right? And what I mean by that, for example, is if I want to just put on the BTC or Ethereum funding trade, which a lot of these yield-bearing stable coins like Athena tend to do, I need to go out and buy Ethereum, and then I need to go sell the perp. And because Ethereum is typically a high-quality liquid asset, I can count that as collateral and have a netted position, right? Now, obviously, a lot of these protocols will have structured deals with exchanges that let you have off-exchange liquidity and have assets sit in a tri-party account. But if you're now trading funding rate on, dare I say, the fart coins of the world, popcats of the world, this very long tail of assets, it tends to only be institutions with larger balance sheets that can really compress those funds because they have to pony up the capital to go out and buy the spot and then independently collateralize the perp leg because exchanges don't think that these long tail assets are high quality liquid assets and should be posted as collateral. So there's funding risk, there's capital risk, there's volatility risk, there's operational risk, there's credit and counterparty risk directly facing these exchanges because they're custodial. And so the short answer is I do think that they do pose a form of systemic risk. As for whether behavior and market microstructure has changed, I do think a lot of folks have gone risk off. And what we're seeing now, I think, is just a convergence of a few macro factors. I think you had this de-dollarization and commodities trend that was happening earlier this year. But even now, I think you can feel the malaise, you can feel the exhaustion of the markets as everyone is just waiting for macro to unfold and also seeing what midterm elections kind of bring from a regulatory landscape.
Yeah, definitely. Have these kind of observations influenced the design of Monaco and kind of changed how you guys are going to tackle liquidity, fragmentation, and risk, and all of the things that you mentioned?
Yeah, very much so, I would say. So throughput and latency are necessary conditions, but not sufficient conditions. I think a serious challenge that remains to be solved. And it's a well-defined problem, and I think these solutions do exist. They just have to be adapted for the convergence of crypto and trad worlds, is the risk management problem, right? In a world where you can have portfolio margining, where I can post multiple assets as eligible collateral and have cross margining, I need to be very thoughtful about what the rules and considerations are there, right? Because you want to allow users to have capital efficient positions, but then you also don't want to necessarily have a bunch of toxic collateral that you can't then liquidate into the underlying market. And so, like, the basic premise of how I think margining should be approached is obviously you prioritize high quality liquid assets, you net exposure, but then you need to have various, you can have VAR-based simulations, you can have risk-based sensitivities, which TradFi does very well, and adapt it for crypto. And actually, even market makers like Wintermute, even Evgeny was posting about this, I think a few hours ago, and I responded to one of his tweets saying like, hey, yeah, I think the risk problem is a very well-defined one to solve. And I think we can borrow a lot of off-the-shelf solutions for this. They just need to be adapted for the 24/7 nature of crypto. And I think that's actually going to reduce risk more broadly when you can have continuous margining and you can have greater capital efficiency in those regards.
Yeah, I agree. Do you think that this is more on the institutional side or the retail side to how kind of we can access this liquidity for everybody? Is it more of a mix between the two, or can it be fully for retail as well?
Sure. I would say the capital efficiency matters far more when you've just got a large balance sheet and your cost of capital is high, right? When you've got $1 billion to manage and you're thinking about how to best deploy it, it's a very interesting and nuanced portfolio construction exercise that you need to consider. I think what retail really cares about is they don't want to have to go to different platforms in order to trade cross assets. And what I mean by that is going back to the October 10th scenario, I think everyone who felt the pain of that was just like, okay, crypto is dead. Let's go trade equities and AI and robotics. But it's like, well, why do I need to leave a crypto exchange or platform in order to do so, right? Why can't I tokenize those equities in a regulatory compliant manner and still give users access to it? So I think what we want to do is really change the trading experience for how people approach it, where it shouldn't be, hey, let me have 17 wrap versions of BTC or have a wrap version of a tokenized asset and then take SPV risk. Users don't want to have to think about bridging. They don't want to have to think about gas. They just want a unified trading experience. And the way you do that is abstracting all of that away and enabling them to simply say, think it, trade it. Right? You want to remove these frictions. And the best example I can give, and I think we might have discussed this in previous conversations, was very much Apple Pay, right? Think about how many people pay for their overpriced Starbucks using Apple Pay versus what percentage of users actually know how it works under the hood. I would probably argue less than 10%. But they don't need to know because it's a part of a ubiquitous technology that is a natural extension of what they carry with them every day. So whatever we can do to remove those frictions, I think the better. And especially when you're thinking about non-crypto native audiences, right? I want to get out of this bubble of let's build for other crypto users. We want to build for actual retail, right? We want to build for the same people who are trading on Interactive Brokers or Robinhood on their phone. We want to build for the same people who are like, hey, I want to be able to go to a terminal, apply agentic frameworks, and be able to backtest, create a strategy, and trade right through there. Your average Joe Schmoes.
And do you think that this is going to be the happening in the near future, where wallets and all these kind of really these difficult things in crypto, where you need your seed phrase and you need passwords and kind of have some sort of basic understanding of where to get tokens, how to swap them, to
Mhm.
access these platforms. Do you think this will all be kind of abstracted and just be part of your Apple Wallet, your profile, your bank account, or kind of how do we integrate crypto for the users to without having it become custodial?
Yeah, I think the short answer is account abstraction and gas abstraction, right? You still have people maintain custody, and I think self-custody was a very important 0 to 1 for crypto, and I don't think we should necessarily lose sight of that, right? Like centralization poses its own risk. Self-custody, I think, is the answer and has product market fit. I think you apply account abstraction, you apply gas abstraction, and you don't have users necessarily think about these like native problems in order to use these products. I think that is kind of the inevitable future, especially if we want to attract people who are outside of just the crypto bubble.
Yeah, definitely. With your trading experience as well, trading volatility and now building infrastructure, where do you think this edge is going to be for volatility trading and for options or structured products?
Yeah, so I think structured products is a very interesting term. I think in TradFi, structured products can be very exotic risk. In crypto, structured products really just tends to mean covered calls and cash secured puts. I think for that market to really sufficiently take off, you need broader adoption. You'll probably begin to see more and more covered call ETFs. You'll begin to see the convergence of the spot ETF markets with the actual spot markets on Deribit, for example. And an interesting observation is like the volume and open interest on spot ETF options markets has actually approached, if not surpassed, what you see on the Deribit and Ethereums of the world, right? So I think this is like the eventual next step. It's simply a matter of time, is really the short answer.
Yeah. And how do you think I mean, there's many different protocols, so many different chains with the fragmentation of liquidity. What is kind of specifically the goal that Monaco has in mind, or how to solve this problem and kind of unite all of the different things and make it less complicated and just kind of push the liquidity together, have people be able to access these things and yeah, what is the goal there?
Yeah, so I think it's dual faceted, right? There's one pillar for traders and there's one pillar for builders. When it comes to traders, I think the way you do that is by having sponsored transactions and allow multi-chain deposits, right? Do users really care? And when I say users, again, I'm thinking beyond just the crypto echo chamber, right? Do users actually care what chain they're on? Or did they simply want an expression of a view or idea that they have and they want to be able to monetize it in a world of hyper financialization? I think the answer is the latter. I think there are ideologues and people who are saying, "Hey, on this chain, I ride or die." And I think like there is a demographic that you can address there. But I think the broader world, more globally, doesn't really care again about the back end. They simply care about an extension of an experience that is already native and natural to them. So the way we do that is again through gas abstraction, account abstraction, allowing multi-chain deposits, removing things like wrapped BTC from the name or wrapped ETH from the name. It's just Bitcoin. It's just Ethereum. And I think the sooner we do that, the better. You don't need 4,000 versions of the same thing because then you run into fragmentation problems, right? And that also tends to be a bottleneck when it comes to permissionless markets. Where you can permissionally list perps, you'll inevitably have like 4 versions of Tesla or like 4 versions of silver. And yes, you can say in a capitalist market, efficiency will win out, but why do we have to wait for nature to take its course when we know that users simply want a natural expression of something that is already native to them? So that is the approach from the traders. For builders, I think the way you do that is by giving them a market development kit and taking all of this infrastructure burden of like building a risk engine, matching engine, settlement layer off the shelf and saying, hey, you need to go solve one problem, which is a user acquisition problem, right? Whether you're trying to target a particular geographical demographic, whether it's like Southeast Asia, or you're trying to say, hey, I want to have the most eyeballs across any iPhone application that sponsors trading in the world, like that could be a demographic. Or you can say, hey, I want to launch composable prediction markets for a region that doesn't have them, right? Like pick a niche, pick a demographic, and create a specialized product that you can then plug and play into the shared liquidity layer and infrastructure that we're building. And that is how you win, right? Especially in a world where attention is a very expensive capital. And I think that's what really wins in this world where everyone is fighting for your attention. I think having specialists and giving them a distribution network to win is very much the answer.
Yeah. You've mentioned this unified liquidity engine many
Mhm.
times that Monaco is building. How does it work across spot, perps, prediction markets? And kind of what is this sub-millisecond execution? How does that work?
Sure. So there's two components. I would say the sub-millisecond execution is very much driven by the fact that TradFi and Web2 has already solved the matching engine problem, right? Again, traditional markets operate on the order of double-digit microseconds. I think the fastest tick to trade that I've come across in TradFi is on the order of nanoseconds, and that's like very specialized hardware for that. But the TLDR is like, why recreate the wheel when you can borrow that engine off the shelf and then simply preserve the crypto ethos of auditability, transparency, reconciliation by having on-chain settlement layer. Right, so you get the best of both worlds, where you don't have to compromise speed and performance and throughput while still preserving the integrity of what you're trying to solve. That's how we achieve sub-millisecond execution and matching, really. In terms of what the universe of primitives looks like for spot, perps, and prediction markets, so having crypto native assets, no brainer, right? In the world of like tokenized equities, which we touched on earlier, with even the New York Stock Exchange is adopting this, that's where I think regulatory clarity really comes into play, and that is a key feature of partnering with the right tokenization partners, right? Some tokenization partners will create wrap versions and abstractions, and then you're taking risk to SPVs that are then issuing these tokens. Others are working directly with the issuers, i.e., the Apples, Amazons, Microsofts, NVIDIAs of the world, to say, hey, I want you to count this tokenized version of your asset as fungible, and I need you to be the issuer and work with me in order to do so. That I think is a more compliant way to do it. But then you get into nuances around broker dealers, and that's where I think offering KYC, KYB for regulated securities and commodities off the shelf as a feature is not really a friction, right? It's adapting for the actual world that we live in. And it doesn't have to be an all or nothing. It doesn't have to be permissionless or fully permissioned. For crypto native assets, you can remain permissionless. For tokenized securities and regulated commodities, you can have permission markets, and you can have both of those sit in the same central limit order book.
Yeah. So what is kind of the key technical difference between what Monaco is building and how existing SEXs or DEXs are currently operating?
Well, I would say one kind of guiding North Star, and there's many, but like one prime example is, why do we think that tokenized equities are not seeing more liquidity on chain? And I think one prime example of that is, what is the incremental benefit of me holding tokenized NVIDIA on chain if I can't borrow against it? I'm not really lending it. I can't post it as collateral. There's no real actual utility, right? And that I think is an actual broader symptom of this RWA discussion. I think simply replicating existing off-chain mechanisms and simply creating a digitized abstraction of them is an incremental progress. But if you're not giving people utility for that capital, then you're not really solving the actual core problem that they want to solve, which is, hey, I have X dollars of something. It's a volatile asset. It's not dollars, but it has X dollars of a volatile asset. How do I put this to productive use? Right. And so how do we answer that? Well, imagine you can post tokenized equities as collateral, right? I would like Monaco to be the first DEX in the world to allow you to have a basis position on NVIDIA. No other DEX or centralized exchange really lets you do this in a capital efficient manner. And I think it's a no-brainer that like that's what this world actually needs. Otherwise, why even have a tokenized version to begin with, I think.
Yeah, no, definitely. I agree. It's been such a pleasure to have you on the podcast today. Thank you for joining me. I have one more question for you. Kind of, what is your outlook on the market right now? I feel like things are going down. Are we in a bear market? When's the bull market? How are you managing your trades and de-risking yourself at the moment?
Sure. Personally, I try and make sure that no more than X percentage of my overall portfolio is in crypto, and I think that's purely a broader risk management exercise, just given our respective livelihoods. In terms of my broader macro outlook, I would say we're very much in a consolidation phase. I still have resting bids at BTC for 65K and 60K, and that's not a price forecast by any means. It's simply, I think that is a discount to the long-term fair value, and if you're a long-term investor as opposed to a day trader or a short-term momentum trader, then I think you are not as bound to hard prices, and you're thinking about it more as cycles and the unfolding of macro events. Right. I think it's going to be interesting to see how the de-dollarization story plays out. It's going to be interesting to see how commodities react to it. I think the election of Fed chair or the settling of the Fed chair, the midterm cycle with Democrats versus Republicans, I think a lot of these things are incremental coin flips with not 50-50 odds. So the compound effect of this is going to be very interesting to see over the rest of this year.
Yeah, yeah, I agree. Well, thank you so much for joining me. I will see you in ETH Denver, and thank you everybody for listening. Stay tuned for the next episode, and have a great